In this video, I'm going to continue and finish our discussion of profitability analysis using ratios that we started when we met in class on June 2nd. In class, we wrote down the definitions and implications of the following ratios and also looked at the values of each ratio for GAAP, Urban Outfitters, and American Eagle. Those ratios were gross margin, operating profit margin, net profit margin, ROA. ROA is a function of net profit margin and asset turnover, ROCE, return on common equity, and also ROCE as a function of net profit margin, asset turnover, and financial leverage, also known as the DuPont ROCE or the three-step ROCE. I want to begin this video here as this is where I left off in our last class meeting. Next, I'll introduce the five-step or extended DuPont ROCE model, and then we'll examine how a change in tax rate and a change in gross margin can impact a company's profitability ratios. Finally, we'll look at a few practice questions. We can begin by writing some notes on the DuPont ROCE, three-step ROCE. But before I begin with that, let me just review that return on common equity in its most basic form is net income minus the preferred dividends divided by average common stockholders' equity. We're going to break this down using the DuPont or three-step ROCE to get a better idea about what's driving the return on common equity. DuPont ROCE breaks down ROCE into three terms: net profit margin times asset turnover times financial leverage. Net profit margin, remember, net income divided by sales. Of course, you can see here we need to subtract out. We didn't subtract out preferred dividends when we looked at our net profit margin, but to be consistent with return on common equity, common meaning we want to take away anything that doesn't belong to the common stockholders, and including the preferred dividends. Now, in this course, the companies that we're going to analyze do not have preferred dividends, so we can ignore them for purposes of this class. We can ignore preferred dividends here, but just know when you get to the CPA exam, in case data is given related to preferred dividends, always subtract those out. So for the purposes of this class, let's just ignore the preferred dividends. Most companies do not issue preferred stock, so we don't have to worry about them. The return on common equity is going to simply be the return on equity. So we have net income over sales for our net profit margin. And again, what this indicates is how profitable were sales. After including all expenses, how much of our sales dollars remains as net income. We're going to multiply this by the asset turnover, which remember is sales divided by average assets, average total assets. And again, what this indicates to us is asset use efficiency. How efficient was the company in using its assets, its cash, accounts receivable, inventory, plant, property, and equipment, and intangible assets in producing what the company's in business of doing, producing sales. So how efficient were assets in generating sales? And finally, remember what we are talking about here is this denominator for the return on common equity is average common stockholders' equity. We want to get some information about how much the stockholders put in and what are they doing with the money that they put in plus the money that the company borrows from its lenders. They are purchasing assets. So how much are average assets as a percentage, or how many times greater are average assets than the amount the common stockholders' equity, amount of average common stockholders' equity from the balance sheet. And what this indicates is how the assets were financed. Remember, the company uses. The company invests in assets in order to run the business, produce sales, run the business, but has to finance those assets. There's two ways that the company can finance its assets: liabilities and equity. And each company chooses its proportion of debt to equity. This measure here, this financial leverage, with the way that it's set up, higher financial leverage. If you have, the more assets you have compared to your equity, indicates that the company is financing more with debt. Lower numbers would indicate that the company is financing more with equity. All right, so let's take a look at this information now that we have it here for our three companies. Let's start with GAAP. GAAP has an ROCE of 28.0%. We saw that it was the highest of the three companies. We compared GAAP to Urban Outfitters and American Eagle. But now let's break it down and to see what's driving this ROCE for GAAP and compare it to the drivers for the other two companies. So when I go to my analysis of the three companies, all my data is here. I can see my net profit margin, and my net profit margin for GAAP is 5.3%. Before I continue along with this, let's look at one driver at a time. So Urban Outfitters, let me just call this Urban. Urban's ROCE is 8.3%, and let's see how that the net profit margin compares. And let's also look at American Eagle, which has an ROCE of 17.7%. So let's start by comparing net profit margin across the three companies. So Urban Outfitters has a net profit margin of 3% and American Eagle 5.4%. So what can we say here? Clearly, Urban Outfitters has a much lower portion of its sales remaining as income. We can say that its expenses are higher than GAAP and American Eagle. We said that American Eagle has a slightly better net profit margin than GAAP, meaning that it has a slightly better ability to control its cost. So now let's look at asset turnover. How quickly are each of these companies turning over its inventory in order to generate profits? So we have asset turnover for GAAP of 2.03, Urban Outfitters 1.88, and American Eagle 2.11. Let's fill in those numbers here. All right, what can we say about asset turnover? We see that American Eagle, which also has a slightly higher net profit margin, is also turning over its assets much faster than the other two companies. So that's very good news. Urban Outfitters is at the bottom. Not only is it least profitable, it's not turning over. It's not just the inventory here, but generating sales from all of its assets. Because remember here, we don't have inventory, we have average assets. So we're including, let's look at what we're including for, let's say, GAP's. What's on GAP's balance sheet? What are the assets comprised of? Cash, inventory, small amount in other, and property and equipment. Not unsurprising, or not very surprising. So what is it using its cash, inventory, and PP&E to do? To sell stuff. That's what the information we're getting from the asset turnover, sales versus assets. And then we also want to know not just the sales, but how profitable are those sales. Now let's look at this last component, financial leverage. So the common stockholders have to contribute, and this is their ownership portion. This is not simply the common stock. but the actual common stockholders' equity. Remember, the stockholders want to use as much debt as possible because that means that they can contribute a bit less, use that debt in order to earn a return on their assets. So let's look at the financial leverage. How many times greater were the assets compared to stockholders' equity? If you have any questions about where these numbers that you see here are from, there's also individual Excel workbooks. For example, here's GAAP's numbers. Go to GAAP's ratio analysis. If you want to know where this number came from, you can follow the formula here, how it ties into the balance sheet and the income statement. But for now, we're looking for financial leverage, and we have for GAAP 2.58, Urban Outfitters 1.47, and American Eagle exactly the same as that of Urban Outfitters 1.47. What do these numbers indicate? GAAP is using much more debt because its assets are quite a bit greater than its average stockholders' equity compared to these other two companies. So let's put these numbers into our formulas. Before we do this, we can see that we should see clearly, we don't even need to do these calculations out, but we can see that Urban Outfitters so far is going to rank at the bottom. And then what we would expect to see is that American Eagle is more profitable by a measure of profit by a ratio of profitability because its net profit margin is higher than GAAP's and its turnover is higher than GAAP's. But watch what happens when we account for financial leverage or how much the stockholders are putting in, not putting in just in stock, but putting in by their ownership interest in the company. So including retained earnings, subtracting out treasury stock, including accumulated other comprehensive income. So again, we said GAAP's financial leverage is 2.58. Urban Outfitters and American Eagle are both 1.47. So what happens here? Remember we said American Eagle had much higher profitability here, but then we see its financial leverage is lower. So what are we saying? That American Eagle is financing its assets much more so with equity. So that return to the equity holders is going to be lower for American Eagle. And that's what we see here, 16.7 compared to that of GAAP. In other words, GAAP is using more debt to finance its assets, and that is benefiting the common stockholders because their portion, the total common stockholders' equity, has a smaller denominator when we look at just the general formula for ROCE. The smaller we can put in the common stockholders' equity, holding net income constant, the higher the return on those common stockholders' equity. So we can see that that's a very big driver here for GAAP. Why don't we look at the profitability of debt or the return on debt in our analysis of profitability? See, we have common stockholders' equity here, but we haven't looked at debt in any of these equations. Why not? Well, the debt holders are entitled to receive interest payments and return on principal, but nothing more. The profits of the company don't belong to the debt holders. They belong to the owners of the company, which are the common stockholders. Of course, if the company is not profitable over time, the debt holders may not receive the principal and interest. So they're somewhat concerned about profits, but they also know that if they have a debt covenant, meaning a debt agreement with the company, and if the company violates part of that agreement, repayment can be expedited, assuming that's in the contract. Otherwise, the debt holders know that if the company approaches bankruptcy, they get at least some of the money back by selling off the assets of the company. So when we look at the debt holder's perspective or solvency, we're going to be concerned with the debt to asset ratio more than income compared to debt. All right, our last profitability analysis breaks down the DuPont ROCE even further. This time, it's going to break it down into 5 components. We call this the extended or 5-step ROCE. And what we're doing, so with the 3-step, we looked at these 3 components. We're still going to include in the 5-step financial leverage, and we're still going to include asset turnover, but we are going to break down net profit margin into 3 components. So let's start with that. Let me just start one more time. Net profit margin times asset turnover times financial leverage. We break down the net profit margin into 3 components to get a better idea of what's driving net profit margin. So how can we break down net profit margin further? Well, we're going to do it in a way that's very similar to how the income statement is reported. What is reported? What are the major subtotals on the income statement? Operating income, income before interest, income before taxes, and then finally net income. So remember, we're isolating interest expense, and we're isolating income tax expense from that operating income, right? We talked about a couple weeks ago, we talked about why we do that. And so we are going to take that same perspective to break down net profit margin into ratios rather than line items specifically from that income statement. So we're going to break down net profit margin into operating profit margin. Remember, operating profit also goes by the term EBIT, so we can also call this the EBIT margin. Operating profit margin times, we're going to introduce, we need some measure of interest. We're going to call this the interest burden. It's not a very good explanation of what it is, but it relates to the interest, and this is what the CPA exam is going to call it, so we are going to be consistent with that notion of interest burden. And then we need something about taxes, and again, this is called the tax burden. I would say that's burden is a little bit misleading, but we'll be consistent with what you need to know for the CPA exam. Operating profit margin, again, operating income, or income from operations, or EBIT, earnings before interest and taxes, divided by sales. How much of our sales end up as operating income after controlling for, of course, our operating expenses, including cost of goods sold. And now, interest burden. So this does not include, this first ratio here does not include interest or taxes. We need some ratio to tell us information about interest, and we take income before taxes. So this is our operating income, including interest expense or interest income, and we divide that by operating income. And then we need some sort of accounting for the tax components on income. So we take as our numerator net income divided by income before taxes. We can see that this works algebraically because our income before taxes would cancel out, our operating income would cancel out. We would be left with our net income over sales, which is our net profit margin. And we're not forgetting that we still have to bring down the times asset turnover times financial leverage. All right, so let's look at this breakdown, this 5-step breakdown for our 3 companies. So GAAP, remember GAAP's ROCE is 28%. Let's look at how that breaks down into our 5 components, and let's also compare it to Urban Outfitters, which has an ROCE of 8.3%. and American Eagle, with that, which has an ROCE of 16.7%. Remember, we've already done the asset turnover and financial leverage. We can just plug those numbers in at the ends. Let's really focus now on the drivers of net profit margin. All right, so first we want the operating profit margin of the 3 companies. Here we go. Operating profit margin, or EBIT margin, for GAAP, 9.3%, Urban Outfitters, 7.2%, and American Eagle, 8%. So which one of these three companies is best controlling its operating expenses? We can say it would be that, it would of course be that which has the highest operating profit margin, which clearly would be GAAP. But we also care about interest and taxes. Let's focus on interest now. Income before taxes divided by operating income. I've done the work on each one of these three company named Excel sheets, and I have the data here. So we are looking for interest burden, pre-tax income or income before taxes divided by operating income. And we see our numbers here. So the reason I say that this doesn't really look like an interest burden is the burden to me would be the difference. The 3.7 for GAAP would be the interest burden to me. What portion of operating income is the interest? But we're showing it the other way, kind of 1 minus the interest burden. But well, let's be consistent. This is the interest burden, 96.3%. 100.6% and 94.8%. So why is Urban Outfitters above 100%? Well, if we look at Urban Outfitters' income statement, we'll see our answer there. So remember, we're only looking at the most recent year. Let's look at income from operations here. Then we have interest income and not any interest expense. So we include this interest income. So that's not a burden. It is the opposite of a burden. So we are going to see that it actually helps us. What does that mean? It means that they have more interest revenue generating assets, treasury securities, investments in any sort of interest bearing investments that's greater than the interest paying debt financing for the company. All right, so let's plug in our numbers here that we saw earlier. GAAP's interest burden is 0.963, Urban 1.006, and American Eagle, just to be consistent, let me take this out, 0.948. So which company is paying has the highest interest expense? American Eagle, the lowest interest expense. What's the company with negative interest expense or interest income? And now let's look at this tax burden. What is our tax burden? Tax burden is net income divided by pre-tax income. We can look at this tax burden. If we took 1 and subtracted out the tax burden, 1 minus 0.596, what we would get, of course, is the tax rate. So this is really just 1 minus the tax rate. So for GAAP, 59.6, Urban Outfitters, 41.4, and American Eagle, 71.1. Looking at these numbers, which company has the highest tax rate? The company with the highest tax rate will have the lowest tax burden, the lowest portion of net income that remains of its pre-tax income, and that's Urban Outfitters. So let's plug these numbers in. And again, what we're doing is just trying to see what's driving the return on common equity. We could see here, this highlights part of what's driving American Eagle's lower return on equity is the fact that it has a very high income tax rate. And a medium, compared to our other peers here, a medium operating profit margin. All right, we're not going to spend much time on asset turnover or financial leverage. That remains the same as what we had before. So we have 2.03 and 2.58. We've already discussed these. And 2.11 times 1.47 if we do the math out, which hopefully you will recreate your spreadsheet of, I would recommend doing GAAPs or one of these companies in Excel and perhaps working through the other two using their balance sheet and income statement information, perhaps writing them out on paper since that's how the final exam is going to appear. Although it's easy calculations, you might think, watching it is enough and not actually working through it. But if you haven't done this several times before in other classes, then it's definitely worth just working out. Even though they're pretty basic calculations, the more we do it, the more familiar we get with why we're doing what we're doing, what the numbers actually mean. All right, so now that we've completed our discussion of the 5-step DuPont or the extended DuPont ROE, you can see down below here I have some of my liquidity ratios, and below that some solvency ratios. We'll get to that in our next video. But what I would like to do next is start looking at some interpretations of how did changes in business affect our ratios. And you've seen that information here under gaps. I've worked through 2 separate business scenarios. One, what if the tax rate changes? Let's assume, so now let me go back to my notes. So here's a question for you. Assume GAP's tax rate, maybe due to the recent changes in tax legislation. Assume GAP's tax rate decreases 15%. Assume everything else stays constant. How will that impact profitability ratios? So 2 questions here. Which ratios would be affected by a decrease in the tax rate? And also, how so? How will those ratios change? Let's make a strong assumption here that as that tax rate decreases, any cash that the company saves would immediately be distributed as dividends. So we're not worrying about cash that could be further invested in increasing income. We're assuming everything else stays constant. All right, so what would we do here? Well, first thing we need to do is figure out what the previous tax rate was. And how do we do that? Well, we take our income tax expense as a percentage of income before taxes. And we see that previously it was 40.45%. And when we decrease it, the new tax rate is going to be our previous tax rate minus 0.15, because we're told that the tax rate goes down 15%. So what is our new tax expense? Well, what should we do? How would we calculate the tax expense after this change to the tax rate? We would take our income before taxes, because we're told nothing else changes. Take that income before taxes and multiply it by that new tax rate. We would get 362.4 is the revised tax expense, and a revised net income of 1062. So now, what ratios would be affected by this? Well, anything that accounts for income tax expense and anything that accounts for net income. Clearly, gross margin would not be affected. Operating profit margin would not be affected. Net profit margin would be. So what do we need to do? When we calculate the new net profit margin, use the new net income and divide it by, well, sales didn't change, so the previous sales number. So we see net profit margin went from 5.3 to 6.7%. Would return on assets change? It would, because net income changes. So we would have to calculate our new ROA is equal to the revised income after the change in income tax expense, and divide that by average total assets. Of course, average total assets don't change. Remember, I said, just for simplicity, assume any cash savings were immediately distributed as dividends. Asset turnover would not be changed. Return on assets, we don't need to worry about. Return on common stockholders' equity, would that change? Clearly it would, because we know that our net income changes. Would average common stockholders' equity change? Well, let's assume it does not. Let's assume everything stays the same other than our tax expense and net income. So what happens? We use our revised income number, which is now higher. Assuming average common stockholders' equity doesn't change, we see the increase in return on common equity to 35.1%. Let's take a look at one more change. Let's now, separate scenario, independent scenario, assume that GAP's sales and cost of goods sold both increase 6%. So we're assuming that sales volume goes up 6% and that also increases cost of goods sold by exactly the same 6%. Which ratios would be changed and how so? Let's look at GAAP. So what I did was I went to the income statement and said, okay, here's my scenario. If sales increase 6%, I take my original sales and increase them by multiplying them by 1.06 to increase them 6%. I do the same things for cost of goods sold. I could simply just go to gross profit, increase that by 6%. We're assuming that operating expenses are unchanged. This was just, let's say it was just a result of a better economy and not the company advertising more or putting any more or hiring a better CEO and paying more to the new CEO. This is going to give us a new operating income. Interest expense will remain the same. We assume that nothing else changed. Interest income, we assume change in gross profit doesn't affect interest expense or income. We're going to recalculate our income before taxes. Our income tax expense, just for simplicity, we're going to assume the exact same amount of income tax expense. That's not very likely, but just to identify the impact of one change here. And we're going to recalculate our net income and see how it increased. So what ratios would be changed if the gross profit increased? Clearly, the gross profit margin, the gross profit in dollar amounts does change, but the gross profit margin stays the same. Why is that? Because sales went up 6% and gross profit, cost of goods sold went up by the same 6%. Operating profit margin, we see that that increases. Why does it not increase by 6%? Well, the gross profit goes up by 6%, and we said that the operating expenses remained the same. So we just use our new operating profit divided by the existing sales. The net profit margin goes up. To calculate that, we just use our income statement's revision, or for what operating profit is, operating income, under this assumption that gross profit went up 6%. Return on assets would go up because our net income changed. Our total assets did not, but net income did. Asset turnover is not affected. Return on assets we're capturing up here. We don't need to do the further analysis. And then return on common stockholders' equity. Well, our net income increased. Average common stockholders' equity remained the same. And we can see that the overall net impact is to take return on common equity from 28% up to 40%. That is it for our profitability analysis, introducing new information. Before I complete this video, I would just like to do a couple of practice questions. All right, question number 1 is true or false. If a company's gross profit margin increases, its net profit margin must also increase. True or false? I'd like you to pause this video here if you'd like to take a moment to think about your answer to that and restart once you have an answer in your head. The answer to that is a false. Just because the profit margin increases doesn't mean that the gross profit margin increases. It doesn't necessarily mean that net profit margin increases. What's the difference between the gross profit and net profit? You can look at a company's balance sheet. Income statement. Here is our gross profit here. So let's say if this goes up, causing our profit rate to increase, does that automatically mean the net profit margin will go up? Not necessarily. It's possible that the operating expenses could have gone up by more than the gross profit rate, and it's possible the net profit margin could actually go down. So the answer to this question is false. This information here doesn't tell us about those operating expenses that affect, or interest or tax expense that do affect the net profit margin. All right, question 2. Another true or false. If a company's tax rate decreases and everything else stays the same, its net profit margin must increase. Again, feel free to pause the video here, take a moment to think about it, and come back once you have an answer in your head. If the company's tax rate decreases, and there's no other changes, its profit margin must increase. Again, let's go back to the income statement here and see what's the difference between, we have our tax rate affecting our income taxes. Oops. And comparing that to net profit margin. So if the tax rate decreases, indeed, that's the only change, is that the tax rate goes down. Then the profit margin, how much our income must automatically go up. We're saying nothing else changed. So indeed, the net profit margin would increase. So this answer to this question is true. All right, multiple choice. If Urban Outfitters is able to produce the same amount of net income after closing 10% of its stores, this is not an unlikely scenario, as we see so many stores and so many of the malls closing down. We've seen how Urban Outfitters is not doing quite as well, at least for the most recent year, as Gap and American Eagle. So this wouldn't be too surprising if this actually happens. So if they're somehow able to produce the same amount of income with fewer stores, and therefore reduces its assets without any other changes, assume that the only thing we see is that PP&E goes down, total assets goes down, same sales, same operating expenses, same income. We would expect to see an increase in the company's A, operating profit margin, B, net profit margin, C, return on assets, or D, all of the above. Take a moment to think about this, and we'll come back and look through it together. Okay, so what is changing here? Income is not changing. Sales are not changing. So, because we say without any other changes. So, there can't be any changes to the operating profit margin. So, reducing the number of stores or the asset base will not affect operating profit margin. That would be the same. It would not affect net profit margin. You wouldn't capture the fact that we're doing more or doing the same with less investment. We would only see that through the return on assets. Net income would be the same, but that denominator, the asset base, would decrease, resulting in a larger ROA. All right, last practice question. If a company repurchases shares of its own common stock from investors, in other words, if a company acquires treasury stock, we would expect to see an increase in its A, gross profit margin, B, net profit margin, C, return on common equity, or D, all of the above. Again, feel free to pause right now to take a moment to think about it before I go through the answer. Okay, so you are thinking about when a company acquires its treasury stock with no other changes that we know of, what happens to gross profit margin? Well, what happens? You like to think in terms of journal entries. What happens when a company acquires its shares? Cash decreases and treasury stock increases, which causes stockholders' equity to decrease. Because remember, treasury stock is a contra equity account. So what happened? Anything happen to sales or cost of goods sold? Nope. Anything happen to net income? Nope. Anything happens to the return on common equity? Well, the net income portion stays the same, return on common equity. Remember, net income is divided by average common stockholders' equity. Well, what happened to average common stockholders' equity? The company is taking out some of that stockholders' investment. Stockholders' equity decreases, so our denominator goes down. And what happens when the denominator goes down? The return on common equity would increase. So our answer is C. I hope you enjoyed this video. This concludes our analysis of profitability. My next set of videos will analyze companies' liquidity and solvency.